Hi, today we're going to talk about how debits and credits work with accounts that are classified as assets. And without further ado, let's get started. Hi there, we're here today to talk about assets as a category that exists within the chart of accounts. So when we set up a new account, it may be associated to the category of assets. That category will determine how the debits and credits work. You could have hundreds or thousands of these asset accounts. And, great thing, this is a wonderful thing, assets always go on the balance sheet. So when we have an income statement, you will not find assets there. You will only find it on the balance sheet. Assets are defined as something that can generate cash for the organization, they have value to the organization, and they can be used to meet financial obligations. So what happens in a business that will cause us to work with assets? For one thing, we may have a product or a service that is rather expensive, and a customer may want to buy it on credit. When a customer does that, it creates an accounts receivable that will reside on our balance sheet. That is an asset to us because it represents money that is owed to us. So if we give a customer credit of 20 days or 30 days in order to pay their bill, then we have to represent that on the balance sheet as money coming to us. Also, a company will need inventory. Not every company needs inventory. Some companies are completely service-based companies. However, there are so many companies out there that need inventory. You could have inventory like if you walk into a Starbucks store and you want to buy a Starbucks mug. That mug is something that Starbucks didn't produce themselves. They bought that from somewhere and they had a Starbucks logo put on it or something like that. They may have bought it for $1 and they're selling it to us for $5. That's a resale of merchandise. However, Starbucks did take green coffee and various packaging materials and those kinds of raw material or inventory classes, and they create a roasted coffee. So when you see that packaged coffee, that's something that Starbucks actually manufactured, and it is in inventory. It sits in inventory until it is sold. A company can also have an asset that is what we call a fixed asset or property, plant, and equipment. And we can buy those outright or we can build them ourselves. For example, we might buy land, we might buy a building, we may build a building. And in offices, we have computers and we have copiers and we have all kinds of stuff that are fairly expensive pieces of equipment, and we will carry those on our balance sheet as an asset. Because at some point in time after its useful life is over, we can get some pennies on the dollar for disposing of those assets. So we want to carry what the book value of that is for as long as we own it. And then last but not least, is cash. We have cash is an asset. We all understand that. And so I don't think I have to explain that one too much further than that. So let's look at debit and credit behavior, looking at a couple of different examples here. So inventory. When we want to add to our inventory, then we're going to purchase it and it's going to be a debit to inventory. When we reduce our inventory, it's because we have sold that inventory. So when we subtract from inventory, we're going to credit it. So the basic minimums that you need to understand from a logic perspective is that the ending balance or the normal balance that sits on an asset account is a debit balance. So at the end of a period, when we add up all the transactions that can go into inventory, the net dollars that we need to have is a debit dollar amount. And if we want to increase assets, we debit it. If we want to decrease assets, we credit it. Those rules are going to be the same regardless of the type of asset that it is. Our next example, fixed assets. So if we want to add to our fixed assets, then we're going to purchase something outright? Are we going to build it, one or the other, to add to our fixed assets? When we subtract from fixed assets, it's because we're now disposing of that asset. All the rest of the rules remain exactly the same, just like what we talked about with inventory. Next, accounts receivable. So when we have given a customer credit and they have purchased a product from us, then we're adding to our accounts receivable. When we actually get the cash from them, we will credit this account, which reduces that balance in the accounts receivable. All the rest of the rules, as shown there, look exactly the same. And finally, cash. When we receive cash, we're going to debit that account. If we use cash, we're going to credit that account. And as you can see, all the rest of the rules, they're all exactly the same. So as a recap of assets, the normal balance, or that ending balance at the end of a period, is always going to be a debit amount. Types of assets are buildings, equipment, inventory, cash, and accounts receivable. With these assets, we can generate cash that can meet future obligations. All asset accounts, regardless of what it is, will behave in this manner when it comes to debits and credits, and assets will always go on the balance sheet. So thank you for your attention today. We'll be on to a new subject soon. Thanks.